Good morning, class. My name is Enoch Banda. I welcome you to our first lecture of investment management. So this is the introductory part of investment management. We know an investment is it's a sacrifice that you make today in order to have future returns. So you decide to make an investment looking on what returns it will have for you in the future. That is what investment is all about. Investment has risks, it has got profits, it's got losses. So in as much as you are making a decision to start investments, you need management. Management is about controlling, planning, and making sure you have the maximum returns that you want to see at the end of the day. That is what investment management is all about. So the lecture layout will start with defining what investment management is. What is investment management? Then it will go to the objectives of investment, the role of an investment manager, agency theory and corporate governance, key concepts of investment management, compounding and discounting. So regarding the book that we are going to be using for this course or subject, it will be corporate finance, and we are looking at, we've chosen that book because it is the book that deals with what investment is all about, the decisions, the risks, and everything that is involved in investment. Investment management. Investment management is concerned with the efficient and effective management of finances of an organization in order to achieve the objectives of that organization. You know, what do we mean when we say efficient? When we say efficient, it is using the lowest possible cost in order to attain maximum desired output. So if you make an investment today, you invest something of 20 kwacha. In a period of 1 year, you expect that 20 kwacha to have a profit or an interest on it. For example, you earn 25 kwacha by the end of the year. Your profit difference will be 5 kwacha, and that would be a very good investment to you because you haven't made a loss. Your sacrifice you've made for the present has ensured that you are able to gain a profit from the future. That is what investment is all about. Moving on to slide 3. So these are the breakdowns of now what investment management involves. It involves planning, controlling, the provision of resources. You know, for you to invest, you cannot just invest in thin air. Probably you need resources, you need money for you to start up an investment. And then you need allocation of resources. Allocation of resources, you need to make sure that the investments that you're doing are with the right planning. Because if you do not allocate resources, you might end up misusing resources. And you and I agree with me to say that the main question which we deal with, or the main thing that we deal with or struggle with in our everyday life in economic terms is management of scarce resources. So in as much as we are dealing with resources, we need to utilize the resources in order to gain a maximum return, whilst we are also safeguarding those resources for the future, because we do not invest once, we shall need those resources to be used again in the future for other investments. Control of resources, which is making sure that you do not misuse resources, but you're making sure that you're utilizing the scarce resources in as much as you are carrying out those investments. The difference between investment management and accounting. Investment management. Investment management is inherently forward-looking and based on cash flows. So like, what do we mean when we say inherently forward-looking and based on cash flows? You invest today, and what you're going to be looking at are future cash flows. What is being added on to the investment that you've done today? You invest a 10 kwacha today. What will be added on to that 10 kwacha? What will be the interest to that 10 kwacha in next month, the other month, the other month, and the other month? That is what we mean when we say that investment is inherently forward-looking and based on cash flows. You see? That is what we mean when we say investment management is forward-looking and based on cash flows. And then for financial accounting is historical in nature and focuses on profit rather than cash. So for you to look at accounts, you need past records for the present. You do not need present for the future. You need the converse for investment management. You have to get records which were done in the past, you see, in order for you to check, am I making profit or not? That is what accounting is all about. It is historical in nature and it looks at profit rather than cash. That is what accounting is all about. You see? And we see from the way these two are being displayed, investment management, that they are two different concepts, because one depends on making a sacrifice on the present in order to attain the future, and the other one is making use of the past in order to attain the present. That is accounting. You look at the past records, for example, the bookkeeping records, you look at the profit and loss records, those records which started as you were starting a business, you get all those records until the end of the financial year. And then you calculate the expenses you were doing, you calculate the revenues you were doing, and you come up with a difference and you check if at all you were making profit or losses. That is what accounting is all about. It looks at the past and the present. Whilst investment management looks at the present and the future. You make a sacrifice today and you see what it is going to generate to you in the future. You see. What is the difference between investment management and management accounting? Investment management is concerned with raising funds and providing a return to investors. So you see, for you to make an investment, you need to raise funds. You cannot make an investment without funds. You need funds. And then those funds, when you make them, you ensure that you invest those funds, and then in return, what you're going to be expecting are future returns on the investments that you did. That is what investment management is all about. Then management accounting. Management accounting is concerned with providing information to assist managers in making decisions with the company. Management accounting is concerned with providing information to assist managers in making decisions with the company. So for management accounting, you do not need to make an investment also. You need the records, the past records which are there, and then when you get those past records, you provide them to the managers. And what will the managers do? They'll be able they'll be able to what? They'll be able to make decisions depending on the past records which you have provided to them. Depending on the past records that they have seen, they'll be able to make decisions. If the past records show that the company has been making good profit, probably the managers are not going to make decisions which are going to make a lot of changes to how the business is operating. But in the other scenario, if the past records are showing that the company has not been doing fine, it hasn't been making profit, it has been making losses on several occasions, probably that would be a good information to, probably that is going to provide information to the managers to see to it that the way the company has been running of late, it hasn't been making good profit and several changes have to be made. That is what management accounting is all about. Then, while accountancy plays an important role within investment management, the fundamental problem addressed by investment management is economic. That is how best to allocate the scarce resources of capital to yield maximum returns. From this point, we can see that investment management is concerned about the economic well-being. You see, in as much as you are making an investment, you make sure that you have followed the way the economy is performing of late, rather than the accounting books or the records which shows just money transactions or the cash from one point to another, but you make sure that you see how the economy has been performing of late. That is what investment management is all about, because you can't make an investment today in an environment where you know that it hasn't been doing fine, in an environment which has got higher inflation rates, in an environment which has a lot of higher taxes, in an environment that has got low interest rates on your investments. You make sure that in as much as you're making an investment, you get full information about the environment that you're investing in, the economic performance that you're investing in. You make sure that the exchange rate of that environment that you're investing in is of good performance. That is what you need to consider before you make an investment. You see, you cannot decide to make an investment where you know that the returns are going to be lesser than what you raised. You cannot make an investment, let's say 30 kwacha, you want to invest it, and after a year that 30 kwacha is going to give you a 25 kwacha, or even a 28 kwacha, or even a 29 kwacha. That wouldn't be a good investment to you, because the returns that you have are in negative terms. You see? Hence, in as much as you are deciding to make an investment, you need full information on the economic activities of a given area that you want to operate in, or a given investment that you want to invest in. That is what investment management. And then you make sure that in as much as you are investing, you allocate the scarce resources of capital to yield maximum returns. You know, for example, some investments we do involve resources which we cannot recycle. You see, so in as much as you are investing such capital or such resources, you make sure that those resources yield the maximum returns, and you make sure that you efficiently allocate them in order to avoid losses or misuse of resources. Investment management objectives. Aim in investment management is the optimal allocation of scarce resources or investments available to them. So you make sure that whatever you want to invest today, you do not misuse it. You make sure that you invest it with efficiency. You make the right investment at the right time. You do not just invest because you want to invest. You make sure that you invest in something at the right time, not just because you have the resources, you just start investing anyhow. That is not what investment management is. It involves you allocating resources efficiently. That is what investment management is all about. The objective should be to make decisions that maximize the value of the company for its owners. You as an individual, you as a company, like I said, you do not need to invest in an investment that does not yield you the maximum output. You see? You need to invest in something that you know that in the future it is going to provide more than what I have sacrificed for today. You know, you do not need to invest in something that is going to give you a loss. That won't be investment management. Financial objective of investment management is stated as maximization of shareholder wealth. So like you as a shareholder of that investment, you make sure that whatever you have put in today generates more than what you generates more in the future than what you put in today. That is what investment management should ensure at the end of the day. And then you have a corporate structure because when you're dealing with investment, you're dealing with the corporate world. Shareholders receive their wealth through increase in value of their wealth in the form of, so like dividends, these are profits that are retained to, these are profits or monies that are retained to shareholders, like the owners. You as a shareholder, you are the owner of that investment. That is what dividends are. And then capital gains, these are profits that are realized from the sale of assets. And capital, these are assets that we the shareholders own. The owners of the business are the owners of the capital, and from that they gain profit. The role of a corporate manager or an investment manager. Corporate managers are responsible for making decisions about raising funds, the financing decision, allocating funds, the investment decisions, and how much to distribute to shareholders, the dividend decision. So like, in as much as you're an investment manager, you need to plan. You need to think critical, you need to be rational between investment A and investment B. Which one am I going to take between investment A and investment B? You see, because you do not decide to invest in an investment or in a project that is not going to yield you future positive returns. If you earn less than what you invested, then that investment wasn't a good one. You need to make sure that whatever you invest in today, in the future, it generates more than what you've sacrificed for today. Agency and corporate governance. So managers do not always act in the best interest of their shareholders, giving rise to what is called the agency problem. So like, there are some situations when you are making investments, and those investments, you as the shareholders, you also have managers, you see? And in as much as those managers are operating, they make sure that they are also operating in a situation whereby they are safeguarding their employment. So there are some scenarios in which the shareholders might want some decisions, or maybe they might want some programs to be carried on in a certain manner. But for the interest of managers to protect their work, they also do things in their own way, which they feel like that way is going to help them safeguard their employment. That is what the agency and corporate governance problem is all about. So that is referred to as the agency problem, which is a conflict between managers and shareholders. So this is just a pictorial representation of what the agency problem is, and you can see from this representation that it shows shareholders and the management. So like this representation just describes what the agency problem is all about. Sorry about the slides. They are kind of disorganized. So agency is most likely to be a problem when there is a divergence of ownership and control. When the goals of management differ from those of shareholders and when asymmetric information exists. So asymmetric information is a situation where the manager knows not everything that the shareholders know. That is asymmetric information. So asymmetric information can be person A and person B. What person A knows is not everything that person B knows. And that is a situation which arises during the agency problem. The managers have the information they need to know, but they do not fully know what the shareholders knows. And the shareholders has information about how the company is running, but they do not fully know what the managers are doing. That is asymmetric in information. And these differences are what cause, these differences are the reasons behind the agency problem. An example of how the agency problem can manifest itself within a company is where manager is diversified to reduce the overall risk. So this is an example of a situation in which agency problem can occur. Slide 12. So moving on to slide 12. So like this is a continuation. When the managers now diversify, all they seek to do is safeguarding their job prospects. The shareholders could achieve this themselves by diversification. Monitoring and performance-related benefits are two potential ways to optimize managerial behavior and encourage growth congruence. So shareholders might have goals for their company. They set objectives for their company. That is how shareholders operate with their company. And then with those goals, and we see that there's a situation of agency problem. How are they going to make sure that the agency problem is monitored well and it is solved? They'll make sure that they carry out monitoring and performance-related benefits. You and I agree with me to say that if you are monitoring your workers, there are less chances that they are going to do things against what your objective is and what your goals are. They'll make sure that they'll try by all means to work according to what you want to see, because you are there monitoring them. And then when you use the second one, which is performance-related benefits, you reward people for what? For what they are doing. You reward people for their works. And if you are rewarding people for their works, they'll make sure that they'll continue working hard in order to continue receiving the performance-related benefits. That is what it means when we say we use monitoring and performance-related benefits to control the agency problem. Moving on to slide 13. Due to the difficulties associated with monitoring, incentives such as performance-related pay and executive share options can be a more practical way of encouraging growth. So we've seen that there's monitoring and there's also performance-related benefits. But we see that monitoring somebody, it is something very difficult at the end of the day. And of the two, the one which is more practical and common and easy to implement it is the performance-related benefit. You pay people for how they are working, and that is an easy way of doing it. You and I agree with me to say that if you are paying your worker for extra hard work they are showing, it will be easy for them to work more and the agency problem can be reduced at the end of the day because they are working hard in order to achieve something at the end of the day. That is what performance related benefits can do at the end of the day. So moving on to slide 14, where we are looking at the interrelationships between investment financing and dividend decisions. So we've got investment, finance, and dividends. So for a company that decides to take on a larger number of attractive new investments, and then when we look at the financing part, that company will need to raise finances because you do not start up investments without any finances or resources. And if that company does not have enough finances, that company is going to cut off the dividends, which are the monies that are paid to the shareholders of the company. So if finance is not available from external sources, which is external sources can be banks where you can borrow from, or they can be other people that you can borrow from. If those external sources are not there, the dividends may need to be cut in order to increase external financing. That is what will happen. So moving on to slide 15. So today we are just going to look at just the introduction part of what investment management is all about. And tomorrow we'll continue with lecture 2 on another lecture. Probably we'll start looking at the calculations of the calculations that are involved in some investment transactions. So investment, the company decides to a minute. Okay. So when a company decides, let's go here on dividends. When a company decides to pay higher levels of dividends to its shareholders, what will happen to the financing and the investments? So lower levels of retained earnings available for external investment means that may have to invest external sources. So finance. So if a company needs to pay higher levels of dividends and the financing is not enough for them to pay those the higher levels of dividends, that company will need to cut down the investment it does. It has to reduce on the investment it does in order to facilitate that there are higher dividends. And if from those investments it makes, there are less profits that are realized, that company will engage itself in borrowing from external sources. That is what this is all about. if the company decides to pay higher dividends, that company from its investment, if it cannot generate enough finances, that company should borrow from external sources. So these are the interrelationships of investments, financing, and dividends, dividend decisions. So when you're looking at the investment part, you need to also think about the financing part, and you also think on what are we going to give to the shareholders at the end of the day. If you invest, do you have the required finances? And after those finances, do you have enough to retain, or do you have enough to pay the shareholders? And what you pay the shareholders is what we call dividends. Moving on to, okay, this is still talking about the same relationship that I was saying about investment, financing, and dividend decision. Two key concepts in investment management, two fundamental concepts in helping firms to value alternative choices. So like, there are two things which you need to look at when you're making investment decisions. Relationship between risk and return and the time value of money. You know, when you're making an investment today, you're going to look at the risk and the returns. And not only that, you also look at what would be the value of money in relation to time. You see? So relationship between risk and return. This relationship states that an investor or company takes on more risk only if higher return is offered in compensation. So for example, in most cases, the things that we would want to invest in are those things which have higher return. And the more, the higher the return of something, the higher the risk of something. That is the relationship which is there between risk and return. So return refers to financial rewards gained as a result of making an investment. The nature of return depends on the form of the investment. A company that invests in fixed assets and business operations expects return in the form of profit or in the form of increased cash flows. So the nature of the return, it will depend on the kind of investment that you have invested in. For example, here we see that a company that invests in fixed assets and business operations expects return in the form of profit or in the form of increased cash flows. So moving on to our next slide. Risk. This refers to the possibility that actual return may be different from the expected return. When actual return is greater than the expected return, this is welcome occurrence. So like, you invest today and you invest a 10 quarter today and your expected return was probably a 15 quarter. And at the end of the day, you end up receiving a 20 quarter. You know that is a welcome occurrence, and you haven't experienced any risk, and it's something better because you have made more than what you invested in. That is what it means when we say the actual return is greater than the expected return. When actual return is less than expected return, this is a risky investment, because today when you make an investment, you have an estimation of what you would want to receive. Now, at the end of the day, you realize that what you're receiving, the actual return is less than the expected return. That is a risky investment at the end of the day. Then investors, companies, and corporate managers are more likely to be concerned with possibility that actual return is less than expected return. So in as much as you are investing, you as an investment manager, you are more concerned. You are concerned on the likelihood of the risk that is associated with that investment that you're doing. Moving on to slide number 20. Time value of money. So the time value of money. Time value of money is relevant to both companies and investors. In wide context, anyone expecting to pay or receive money over a period of time. So this is what the time value of money is all about. You expect a certain return after a period of time. That is what time value of money is all about. A 10 quarter today, what will that 10 quarter be after a given period of time? That is what the time value of money is all about. And these are the common decisions that people make. Do I have to get the 10 quarter today, or maybe I should wait for the 10 quarter to be given to me after a period of 1 year? That shouldn't be. Those are the decisions which we make in as much as we are making investments. So time value of money, what will the value of money be after a given period of time? Moving on to slide number 21. So I have 2 more slides to be done with the introductory part of investment management. And we will move on to our next lecture tomorrow. Time value of money. Time value of money refers to the fact that the value of money changes over time. That is what time value of money is. Money is not the same over a given period of time. With time, the value of money will change. It can either increase in value or it can decrease in value. Imagine that your friend offers you either 1,000 Zambian kwacha today or 1,000 Zambian kwacha in 1 year's time. Faced with this choice, you hopefully prefer to take 1,000 kwacha today. And the question is to ask that, why do you prefer 1,000 kwacha today? So there are some reasons why you would prefer to get the 1,000 kwacha today. And let us see what those reasons can be. So these are the reasons why you would want to get the money today and like getting the money after a period of 1 year. So we've got time. If you have the money now, you can spend it now. It is human nature to want things now rather than wait for them. Alternatively, if you do not want to spend money now, you can invest it so that in 1 year's time, you have 1,000 plus any investment income in. So you see, it is our nature to want things to be given to us now. And if at all that is not the decision that you've gotten the money for, you would decide to invest that money so that after a period of 1 year, it can have some returns on it. That is the reason why we prefer to get something today. Then we also have the inflation part. 1,000 spent now will buy more goods and services than that 1,000 spent in 1 year's time, because inflation undermines purchasing power of your money. Let's see, when we look at what 1,000 kwacha can buy today, you and I agree with me that 1,000 kwacha today cannot buy the same amount or the same quantity of goods as it bought last year. This is because inflation rates alter or they affect the value of money over a period of time. Then risk. If you take 1,000 now, you definitely have the money in your possession. The alternative of the promise of 1,000 in 1 year's time carries the risk that the payment may be less than 1,000 or may not be paid at all. So this risk, we've seen that you would prefer to get the money today because you do not know whether next year you'll be given that money, or maybe you'll be given lesser than that money. Or probably another risk, as you are living, you can die. It is human nature to die. What happens if you die today? You will not have that money. You will not get that money. So these are the reasons why you would prefer to get that 1,000 kwacha today and like getting it after a period of 1 year. So we've got, before we move on to the next slide, the same slide, we've got a definition, the definition of compounding. So compounding is the way of determining the future value of a given sum of money. So compounding is what you invest in today, what will be its value next year. That is what compounding is. The definition of compounding is trying to determine what the future value of a given sum of money will be, or what will be the future value of an investment that you make today. That is compounding. And then on the other hand, discounting is the what? Finding the value of a future money, converting it back to the present in order for you to see what it could have valued in a given time period. So the formula for compounding is future value is equals to
Sir,
yes.
can you tell me the definition for discounting again?
Just a minute. The definition of discounting is on the last slide, and I'll give it to you.
Thank you.
Yes. So you'll see the definition of discounting on the next slide. Let me show you the calculation of compounding. So we've got the formula for compounding, which is future value is equals to CO plus CO open bracket 1 plus I close and N, and the initials are here. CO means the sum of money that you've deposited now, and I is the interest rate, and N is equals to the number of years until the cash flow occurs. So here, for example, you have 7 years, that is what you put here. If you've got months, you also